Executive consultants, you're welcome. In our last video, we are looking at group accounts, and we basically looking at IAS27, where we had a parent and a subsidiary. And we should know that under IAS27, where we prepare mostly parents and the subsidiary, we look at control, because when there is no control, then we cannot prepare a group accounts for a parent and a subsidiary. And for a parent to have control, the standard states that he should have 51% onwards. So today we are going to look at something new, not different, but something that we are simply going to add on our IAS27, and that is going to be IAS28, which is going to be called investment in an associate. It is going to be the same, but we need to know a few things before we can go into it. We should know that we talked about significant influence versus control. For one to have significant influence, then that parent must obtain between 20 and 50% of ownership. And when that happens, that means they don't have control, but they have an influence. Hence, they don't have, it's not a subsidiary, because if it surpasses 50 and it goes to 51, then it becomes a subsidiary. So for one to have an associate, they need to own between 20 and 50. And the moment they go beyond 50, then it ceases to be an associate and it becomes a subsidiary where they will have control. So control is for a subsidiary and influence is for an associate. The workings still remain the same by looking at the assets and the liabilities on a line-by-line basis. And then the only thing that we need to do is we do not need to include the assets and the liabilities of the associate. Why? Because we have only influence. So because we have influence and not control, what do we then put under under investment? When it comes to our investment in an associate, we'll only look out for the cost of investment into the associate, which we'll be putting under our non-current assets. But then the rest of the workings, just like we saw in IAS27, are going to remain the same. So we are going to go into a number, and like I've been doing, we are going to use practical examples that I might put a disclaimer that the figures or the financial statements we are going to be seeing, they are not belonging to these particular companies, because these particular companies are in practice. So it just helps us to understand that, oh, this is an associate, this is a subsidiary to this parent, and then this is a parent to both the associate and the other subsidiary. So when I open my work for today's class, we can see we have 3 financial statements. And then we are told we have Berkshire, we have Guard Insurance Company, and Express, American Express. So we need to find out which is a parent, which is a subsidiary, and which is an associate. So we need to go and look at our added information. They tell us that they have given us the following information, and Berkshire acquired its shares. That simply means Berkshire here is going to be our parent. In Guard Insurance Company on 1st January 20x5, when Guard Insurance Company had losses of 56,000. So we do not know if Guard Insurance is a subsidiary or an associate. And then they are telling us that still Berkshire acquired shares in American Express on 1st January 20x5, when American Express had retaining earnings of 140. Then they are telling us that an impairment test at the end of year shows that goodwill for Guard Insurance Company remains unimpaired, and investment in American Express by 2,800. Finally, they tell us that they value their NCI at full value. The fair value on 1st January 20x was 157,000. And then they tell us to prepare a consolidated estimate of financial position for the year ended 31st December 20x5 for Berkshire and its subsidiary incorporating its associated company in accordance with IAS28. So because we do not know which one is a subsidiary, which one is an associate, we need to look at the number of shares that were purchased in both. So they are telling us that 672 shares were purchased in GAD and 168 were purchased in American Express. So this is going to help us to come up with our group structure. So our working one, which is always the group structure, because we need to know group structure. So we will say, we will come and then we will select this, the 672,000 shares, and then we divide by the shares that are in GAD insurance, which are 840,000. Remember, the shares, the ordinary shares of a subsidiary or an associate will not change during acquisition and even after acquisition. So 840,000, and then we will multiply that with 100%. Okay, sorry, forget to put most important thing under Excel. So that means we have 80 for GAD, and then we'll come and then find out when it comes to shares in American Express, 168 shares versus the 560 shares. So I will come and I will say 168,000 shares divide by 560 shares. Then we multiply with 100. Okay, sorry. Just this. So we have 80 and 30. So this is for GAD insurance company, and then the 30 is for American Express. So by what I talked about in our definition, when in our start of today's class, I said if we have 20, between 20 and 50, that is an associate. And if we have beyond 50, that is a subsidiary. So we know by now that GAD insurance company is a subsidiary, hence we will come and then say 100 minus 80. We'll simply come and say 100 because we need to get the NCI, 100 minus this, and then we get 20. So our NCI value is 20%, and then the parent is 80%. So after looking at the group structure, we now need to go and determine the net assets of GAD insurance company. They have told us that share capital, like I said, they had 840,000. So we'll put in that, and then they had a retained loss of 56,000. Because it is a loss, we need to put it into the system as a loss. And then we will have our total as, remember I'm using Excel, so you might be asking yourself, why am I saying sum, yet I have a negative in? But because we know a positive and a negative are going to crisscross, so they are going to give us this value of 780,000. So we will still have 840. And then we'll have our retained earnings at the reporting date. It is very important for you to know where to get this. The financial statements that are provided to us is what we consider as reporting date. And then the additional information is where we get ourselves the acquisition date figures. So we have our retained earnings for our subsidiary as 602,000. So we will come and then we'll put the 602,000. And once that is done, then we'll need to get the total by still saying sum, and then we add up this. Okay, so when we add up this, we need to put commas so that we can be sure. So when we add up this, then we can clearly see that we are going to get our post-acquisition. Why do I always get post-acquisition before I proceed? It's because I know when I'm calculating my group retained earnings, I'll need to find out the parent's share. So I cannot reach there, and then that's when I remember to calculate my post-acquisition. So I'll need to calculate my post-acquisition from from the time I'm determining my net assets. So I'll simply say reporting date minus the acquisition date values. And that will give us our figures, our profit or our post-acquisition for the associate for the subsidiary as 658,000. Then allow me come, and then I also do the same for the associate very fast. We know by now that they have told us that they had 560 shares. So at acquisition, 560 shares. And then they had retained earnings of 140. Remember what we looked at in our additional information. Then we'll add them to know how much do we have as acquisition. And then we'll say at the reporting date, we still have the same value. And then what do we have as our retained earnings for the associate? We have 448,000. So we have 448,000. And then we'll still get to know our total at the reporting date so that we can get to know if we had a loss or profit. So we have 1,008,000 shillings. So we'll say reporting minus acquisition. And once that is done, then we have our post-acquisition. It comes to the American Express, which is an associate, which we'll look later on. So we are going to look at goodwill. But before we look at goodwill, we need to know that even the associate that we purchased, we need to also check and find out if we have goodwill for it. So we'll come again, we'll do our goodwill just like we did in IAS27, and we will still come back to our question, and then we get the cost that was used to purchase shares in GAD, and it was 644,000. So 644,000. Then we are going to take away, we are going to less away the share of P on the on the net assets at acquisition. So we'll say 80% times what we got at acquisition. But because remember we are lessing, so we'll put a comma here so that we have a negative. And then we will have the goodwill for the parent by saying this, take away that. And then we will have to find out the fair value of NC at acquisition, which was told as 157,000. Then we less the share of the subsidiary at acquisition. Remember, we have it as 20, but because we need to have it in negative, so we'll have to put that negative sign, and then we multiply it with this value that we got, and then we'll get the goodwill at NCI by saying sum, and then we'll need to know the goodwill at NCI, which is 200, and then we have to less the impairment. Remember, but they told us that our subsidiary did not have an impairment, so we will not less anything, and that means we'll have our total goodwill as the goodwill for the parent, then we add on the goodwill for the NCI, and we'll have 17,000 as our total goodwill. So this is part 1 of today's class. Part 2 is coming on, and then we'll start right away from the total goodwill that we've stopped at of 17,000 shillings. Executive consultants, let us learn together.